This video will cover both the pricing and the accounting for bonds. The topics covered in this presentation include a little background on bonds to begin with. I will then show how to generalize the three transactions: bond issues, interest recognition, and the recall or retirement of bonds under three scenarios: issuing bonds at face, at a discount, or at a premium. I will then present a couple of examples that will include a calculation for pricing bonds, as well as their journal entries, and finally, I will include a couple of slides on how to determine the carrying value of a bond. Businesses will finance their operations either via equity, such as stock issues, or debt, such as bond issues or the like. Note that debt financing is usually cheaper. The bond terms are the face value, or the amount to be borrowed, the contract rate, stated on the bond contract, expressed as an annual rate, and then the maturity date or term, usually in a semi-annual or annual basis. The expense generated from the bonds from the issuer's perspective is interest expense. Now, from the investor perspective, it is interest revenue. The cash flows from the bond issue are the inflow of borrowed funds from the investor and the outflow of interest payments and the return of the borrowed funds at maturity. I will mainly focus on the issuer side of these transactions in the lesson, so you should review the investor side on your own. The three transactions that relate to bonds are: 1. The bond issue, essentially the borrowing of cash from an investor. 2. The recognition of interest expense. Note that in the case where there is a discount or premium, the interest expense will have two sources: the interest payment itself, which is always the same regardless of scenario, and the amortization of the discount or premium. More on this topic below. The third transaction is a recall or retirement of bonds. I will not cover this last transaction in this presentation. The three scenarios are a function of the difference between the CR or contract rate and the MR or market rate, also referred to as either the effective rate or discount rate. If the CR equals the MR, then the bonds are issued at face, which means no discount nor premium. If the CR is less than the MR, then the bonds will be issued at a discount. Finally, if the CR is in excess of the MR, the bonds will be issued at a premium. Now, the discount or premium is the difference between what the bond contract says the borrowing should be and what the actual amount borrowed will be. One way to think about this difference is as follows, as shown in this yellow box. Suppose that a bond contract is printed, say on May 1st. The CR was set perhaps equal to the MR of 12%. As of that date, May 1st, the CR printed on the bond contract is set and cannot be changed. Now, assume that these bonds are eventually ready to be issued or sold by, say, May 10th. But by May 10, the market rate for this type of bond has changed to, say, 13%. Yet the issuer still wants to sell these bonds. Now, potential investors require the current 13% regardless of what the bond contract says. Can these bonds still be issued with a 12% contract rate when the MR is at 13%? The answer is yes. To effectively match the MR that the investor requires, the amount borrowed is adjusted. But by how much should the face amount be either decreased or increased? The answer lies in the pricing of bonds, calculation based on the cash flows that are embedded in the terms of the contract, but present valued at the market rate. I will demonstrate the pricing process below. First, let's discuss the timing of the cash flows. Let's assume a bond that requires several cash flows depicted by the labels t equals 0 through t equals 10 in the slide. the 11 cash flows that come out of the bond are the 10 periodic interest payments, and then the 11th is the return of the borrowed amount or face amount at the maturity date, in this simplified example at t equals 10. Next, let's discuss what are the actual amounts of the cash flows. Let's assume the following are the terms of the bond contract. The contract rate is 12% per year. Interest payments are said to be made every 6 months or semi-annually, and that the face amount equals $100,000. The interest payments are a function of the contract rate of 12% divided by 2 since it is semi-annual payments, or 6%. So we multiply the 6% times the face amount of $100,000, resulting in a periodic or 6-month interest payment of $6,000. The bond will pay $6,000 each period from t equals 1 through t equals 10. Also, at t equals 10, the return of the loan is also done, in this case, $100,000. So what determines the actual proceeds from the issue of the bond? The answer is based on the difference between the face amount, the amount that is stated on the bond contract, which assumes the contract rate, and the amount to be calculated at the present value, or PV, of the cash flows using the market rate. In the following example, I will demonstrate this process. Note that I will simplify the example by only looking at one period instead of 10. In example A, still from the issuer's perspective, Betty Inc. wants to issue a 1-year, $1,000, 10% annual interest bond at a time when the market rate is also 10%. We know already that since the contract rate equals the market rate, there will be no discount nor premium. So we would not need to do any bond pricing calculation in this case. But I will still go ahead and calculate it to illustrate how this is done. At t equals 0, Betty promotes her bond to a number of potential investors. She needs to figure out if she needs to adjust her borrowing amount. This will depend on the total present value of the cash flows from her bond. The cash flows will be $100 interest based on $1,000 face times 10% at the end of t equals 1. And also the return of the face, the loan amount, of $1,000 also at t equals 1. Now the present value of the $100 at t equals 1 back to t equals 0 is a function of the PV factor of 0.9091. This comes from the PV table at 10%, 1 period, times the cash flow of $100. That results in $90.91. That is the PV of the interest. Now the PV of the return of the face is a PV factor of 0.9091, the same one as before, is the same time period, at 10%, 1 period, times the cash flow of $1,000. This results in $909.10. Now summing the PV of the interest and the PV of the face will give you exactly $1,000. Again, there's no discount or premium since the market rate used in the PV calculation is equal to the contract rate. The total interest expense to the bond issuer and also interest revenue to the bond investor is only a function of the interest payment at 10%. This slide has the very same setup as previously. The only difference is that the market rate is now 12%. The process is the same. The cash flows from the interest payment is now present valued at 12% instead of 10%. That results in a PV of $89. I round it to the nearest dollar. The return of the face, its cash flow, has a present value of $893, also present valued at 12%. Summing them up generates a price or proceeds of $982. So that means that when the market rate is higher than the contract rate, the price of the bond will be discounted by a certain amount. The discount amount is effectively additional interest expense to the issuer, also additional interest revenue to the investor. The issuer's total interest expense over the life of the bond will be both the contract interest payment at 10% plus the interest generated by the amortization of the discount, effectively an additional 2%, for a total of 12% that then matches the market rate. You will see how this is reflected in the journal entries shown later in this presentation. This slide also has the very same setup as previously. The only difference is that the market rate is now only 8%. The process is the same. The cash flows from the interest payments is now present valued at 8% instead of the 10% in the at face scenario or the 12% in the discount scenario. At the new 8%, the result is a PV of $93 for the cash flows from the interest payments. That cash flow from the return of the face has a PV of $926, which is also present valued at 8%. Summing them up generates a price or proceeds of $1,019. So as expected, that means that when the market rate is less than the contract rate, the price of the bonds will be at a premium by a certain amount. That premium amount effectively is a reduction of interest expense to the issuer, and at the same time, it is a reduction of interest revenue to the investor. The issuer's total interest expense over the life of the bond will be from both the contract interest payment at 10% minus the interest from the amortization of the premium, effectively a reduction of 2% for a total of 8% interest that then matches the market rate. You will see how this is reflected in the journal entries shown later in the presentation. In the next 4 slides, I will go over another example, example B. This time it will be for a 5-year, 12%, $100,000 face semi-annual bond issue. The 3 scenarios will reflect a market rate of 12%, a market rate of 13%, and then the last one will be a market rate of 11%. You will note that the approach will be very much the same as we just covered in example A. First, let's discuss our 12% bonds issued at a time when the market rate is also at 12%, meaning that the bonds will be issued at face. Note that the interest payments are a function of the contract rate of 12% times half a year, since they're semi-annual, times the face amount of $100,000. This results in $6,000 per period every 6 months. There are 10 interest payments, or cash flows, from t equals 1 through t equals 10, with an additional cash flow representing the return of the loan or face amount of $100,000 at t equals 10. We now need to find the correct PV factor to present value each cash flow back to t equals 0. There are various PV tables and PV formulas we can use. In this case, we are present valuing single cash flows, one at a time. So we will use the single cash flow PV factor table. Once we find the correct table, we now need to find the specific PV factor for our 6% periodic market rate, also called discount rate. Discount rates are found in the columns. We will use a 6% column and the 10th row because we have 10 periods. The PV factor for each period, T0 or T equals 0 through T equals 10, is shown on the slide. Each is multiplied by its respective cash flow. The result is a PV amount for each period. Summing up the PV of the interest payments results in a total PV of $44,161. The PV of the face also at 6% from t equals 10 back to t equals 0 results in 55,839. Summing up the PV from the interest payments and the PV from the face gives us a total PV of $100,000. Again, we already knew that there would be no need to compute this price actually, because the CR equals the MR. Second, let's now discuss the bonds issued at a discount, assuming still a contract rate of 12%, but now a market rate of 13%. Note that the interest payments are still the same. As a reminder, they are a function of the contract rate of 12% times half a year times the face of $100,000. This gives us $6,000 per period every 6 months. And as before, there are still 10 interest payments or cash flows from t equals 1 through t equals 10, with an additional cash flow representing the return of the loan or face amount, which is also still the same at $100,000. This happens at t equals 10. Since we're still present valuing individual cash flows, we still rely on the single cash flow present value table. But the column we will select from this table is different. We will use instead the 6.5 column. That's 13% market rate divided by 2, since we're talking about semi-annual periods. The row is still the same, since we're still dealing with 10 periods. The PV factor for each period from t equals 1 through t equals 10 is shown on the slide. Each is multiplied by its respective cash flow. The result is a PV amount for each period. Summing up the PV of the interest payments results in a total PV of $43,133. The PV of the face from t equals 10 back to t equals 0 at 6.5% is $53,273. Summing up the PV from the interest payments plus the PV from the face gives us a total PV of $96,406. This time there is a difference. The discount is the $100,000 face minus the proceeds of $96,406 or $3,594. Remember that this discount represents additional interest expense to the issuer, amortized in equal amounts over the 10 periods. In this case, we're assuming a straight line method for the amortization of the discount. Lastly, let's talk about bonds issued at a premium. Still assuming a contract rate of 12%, but now a market rate of 11%. Now don't forget, these are annual rates. The interest payments are still the same. As usual, they are a function of the contract rate at 12% times half a year times the face of $100,000, giving us interest payments of $6,000 per period every 6 months. There are 10 interest payments from t equals 1 through t equals 10, with an additional cash flow representing the return of the loan or face amount, which is still $100,000 at t equals 10. Again, given that we will be present valuing individual cash flows, we will use a single cash flow PV factor table. This time, we will use the 5.5% column because we have 11% market rate divided by 2 since they're semi-annual. And we will again use the 10th row since we still have 10 periods. The PV factor for each period t equals 1 through t equals 10 is shown on the slide. Each is multiplied by its respective cash flow. The result is a PV amount for each period. Summing up the PV of the interest payments results in a total PV of $45,226. The PV of the face amount, also at 5.5% from t equals 10 back to t equals 0, is $58,543. Summing up the PV from the interest payments plus the PV from the face gives us a total PV of 103,769. This time, again, there's a difference, as expected. The premium is based on the proceeds of 103,769 minus the face of 100,000 for a total premium of 3,769. Remember that this premium represents a reduction of interest expense to the issuer, amortized in equal amounts over the 10 periods. And again, we're assuming a straight line method for amortizing the premium. Now we move on to the accounting phase by discussing the journal entries, or JEs, involved in the three transactions: bond issues, recognition of interest expense, and the recall or retirement of bonds. Note that as of this writing, the last topic on bond recall or retirements is not included in this presentation. Before discussing the actual JEs, it will be useful to briefly review the normal balances of both the discount and premium on bonds payable accounts. Think of the discount on bond payable account as a contra liability account, meaning that it is a liability account but with an opposite normal balance. Remember that liability accounts usually have a normal credit balance, but the discount on bonds payable account has instead a normal debit balance, and it is attached to the bonds payable liability account to determine the carrying value on the bonds. The premium on bonds payable account is a liability account with a normal credit balance. It is also paired with the bonds payable account to determine the bonds carrying value. More on this point later in the following slides. With respect to the first transaction, the JE for the issuance of bonds shows a debit to the proceeds, usually cash, and a credit to bonds payable. This is the case for all three scenarios: at face, at a discount, and at a premium. The difference lies in the booking of the discount or premium accounts. Using the result from our example B, you see that in all cases there is a credit to bonds payable for the face amount of 100,000. Cash is debited for the full contract amount of 100,000 when the bonds are issued at face. But when the bonds are issued at a discount instead, cash is debited for the discounted proceeds of 96,406, with a corresponding debit to the discount on bonds payable account for 3,594. Alternatively, cash is debited for 103,769 when the bonds are issued at a premium. Its corresponding premium on bonds payable account is then credited for 42,769. Moving on to the recognition of interest expense JE, we see that it includes always a credit to an interest payable account if we accrue interest, or to cash if we're paying instead. In the case of example B, when issuing bonds at face, the interest payable or cash credit is the very same amount as the debit to interest expense, in this case $6,000. When bonds instead are issued at a discount, the interest expense is the sum of the interest of $6,000 coming from the interest payment and the discount amortization amount of $359, calculated using the straight line method. Remember that this is based on a total discount of $3,594 divided by 10 periods. Therefore, interest expense is debited for $6,359, and the discount on bonds payable account is credited for $359, reducing its balance. Note that the effective interest on these bonds is the 12% contract rate, or $6,000, plus a portion of the discount of $359, not borrowed but to be returned to the investor at maturity. This effectively increases total interest by 1% to the 13% market rate. Similarly, but in the opposite direction, the premium on bonds payable account is amortized with a debit of $377, also reducing its balance. That is computed based on the straight line basis. Remember that the premium of $3,769 is divided by 10 periods. The total interest expense is therefore debited for the sum of the interest payment of $6,000 less the amortized premium of $377 for a total of $5,623. Note that the effective interest on these bonds is a 12% contract rate of or $6,000 less a portion of the premium of $377 paid initially by the investor, effectively reducing total interest by 1% to the 11% market rate. Still using example B, let's now turn to the concept of carrying value, or CV, which is the net of the bonds payable account and either the discount or premium on bonds payable. Referring to the discount scenario, note that the initial balance of the discount on bonds payable account was $3,594 at the very beginning of period at t equals 0. At that point, the carrying value was $96,406, the net of $100,000 bonds payable balance and the discount on bonds payable balance of $3,594. Then after the first period's amortization of the discount, the new balance at t equals 1 is $96,765 based on the same bonds payable balance of $100,000 and the new discount on bonds payable account balance of $3,235. Note that the carrying value continues to increase as the amortization of the discount is recorded throughout the life of the bond until the CV equals the bonds payable account balance. That will happen at the maturity when the discount on bonds payable account will show a balance of 0. Similarly, in the premium scenario, note that the initial balance of the premium on bonds payable account was $3,769 at the very beginning of period at t equals 0. At that point, the carrying value was $103,769, the net of $100,000 bonds payable balance and the premium on bonds payable balance of $3,769. After the first period's amortization of the premium, the new balance at t equals 1 is $103,392, based on the same bonds payable balance of $100,000 and the new premium on bonds payable account balance of $3,392. Note that the carrying value continues to decrease as the amortization of the premium is recorded throughout the life of the bond until the carrying value equals the bonds payable account balance. This will happen at the maturity when the premium on bonds payable account will show a balance of 0. As mentioned previously, the last transaction is not yet ready. Please refer to the book. As usual, post your questions in either the chapter discussions in the module or under my virtual office hours discussion thread in Module 0. Thanks very much for taking the time to review this longer than usual video. I hope it proves useful in learning the material in this very challenging chapter.